Heinz for over 3 decades, and over that time we've performed exceptionally well. Now, by putting the research on top, we believe we're going to perform even better than that. When we brought research in-house, we started by bringing Josh. Josh had been the head of research at PPR, an organization that we had worked with as a client. We then asked each other, what is the best way to look at future performance based on what we know today?
As I started to do R&D to come up with a model that informed us of where we were in the capital markets and fundamentals cycle, one of the goals was to take the economic forecast out of it. And I was somewhat skeptical that I would be able to get there, but it turns out using a pricing-based model incorporates the consensus economic forecast, and where prices are is much more important than where the economy is or where people think the economy is going.
We threw a bunch of variables at the wall and said, of these variables, what is the best predictor of what's going to happen in the future? The answer was that we got 2 or 3 variables that were really powerful, and those are the variables that drive our model, and frankly, they're not the variables that drive any other firm's models.
The factor that correlates best to future price growth is current pricing. To be able to buy an asset at a price that is below what we call long-term intrinsic value has a much higher probability of the asset appreciating over the following 5 years than to buy an asset at intrinsic value or above intrinsic value. Then there's an individual asset that the deal team uncovers. And so often those interactions are, is this deal indicative of the market, or is there something special about this deal where pricing is more attractive than the overall market? The access to local market information to me is unparalleled relative to other firms that I used to consult with. I employed analysts that attempted to have close to the market knowledge that the Heinz local teams have. That is a huge competitive advantage because real estate's local, and that local information is vital to the critical execution of investment decisions.
Having a quantitative back-tested framework that you trust, what it allows you to do is get conviction around ideas that are counterintuitive. So in other words, during the boom period in 2006 and 2007, our models would have said it's a good time to sell, but it's hard behaviorally to want to do that because you look around in the market and everybody's doing great and returns are through the roof, and so you don't want to be told to sell. It's much more powerful if you can point to an objective model that has a strong back-testing history, and you can say, historically, when markets look like that, this is what happens, and that's why we should sell today. And then the flip side happens as well.
Coming out of the Great Recession, after we created a research department, they were very strongly saying that now was a great time to be buying, and we did. We got fairly aggressive in what we were able to buy during that period, and since then prices have gone up by a good bit, so it really reinforced that research could be a huge addition to what we do as a firm.
If you want to produce top decile returns as an investor, you've got to do something different. And we think we are doing something different in focusing on price as the predominant factor of future price growth or losses.